Every year, the government hands out free money to people who know where to look. Up to £1,000, completely free, every single year. No catch, no competition, no application process. You just have to know it exists and be under 40 when you open the account. Most people have no idea this is available to them. Today we are covering the Lifetime ISA. What it is, how the bonus works, who it is actually for, the catches most people miss, and exactly how to decide whether it belongs in your financial plan. Here is a number that should get your attention. If you're 25 years old, open a Lifetime ISA today and put in the maximum £4,000 a year until you turn 50. The government will have given you £25,000 for free, simply for saving money you are probably going to save anyway. That is not a rounding error. That is £25,000 of someone else's money sitting in your account, growing alongside your own contributions, completely untouched by tax. The Lifetime ISA is one of the most generous financial incentives the UK government has ever created, and it is consistently one of the least used, not because it is complicated, simply because nobody talks about it clearly enough. So what actually is it? The Lifetime ISA is a specific type of ISA designed for two purposes and two purposes only: buying your first home or saving for retirement. You cannot use it for anything else without paying a significant penalty, which we will cover shortly. Here is how the bonus works. You put money in, up to £4,000 per year, and the government automatically adds 25% on top, every single month. Not at the end of the year, not as a lump sum, month by month as you save. Put in £4,000 and the government adds £1,000. Put in £2,000 and the government adds £500. The bonus scales exactly with what you put in, up to that £4,000 annual maximum. And crucially, the bonus itself earns investment returns inside the account. The free money grows alongside your own money. That is the compounding effect of a government contribution, and it starts from the moment you open the account. There are 4 rules you need to know before you open one. Rule 1. You must be between 18 and 39 years old to open a Lifetime ISA. You can keep contributing until you turn 50, but the account must be opened before your 40th birthday. Miss that window and it is gone permanently. Rule 2. The annual contribution limit is £4,000. This counts toward your overall £20,000 ISA allowance for the year. Rule 3. You can only use the money for 2 things: buying your first home or withdrawing from age 60. Anything else triggers the withdrawal penalty. Rule 4. The property you buy must cost £450,000 or less. Worth knowing up front if you're buying in a higher priced area. Let us look at the first home use case, because this is where the Lifetime ISA is most powerful for people in their 20s. Say you're 25 and you want to buy your first home in 5 years. You open a Lifetime ISA today, put in £4,000 a year, and the government adds £1,000 each year. After 5 years, you have £20,000 of your own money and £5,000 of government bonus. £25,000 toward your deposit before any investment growth. On a property worth £250,000, that £5,000 bonus could be the difference between a 5% and a 10% deposit. That single difference saves you thousands in mortgage interest because lenders offer significantly better rates at higher deposit percentages. The Lifetime ISA bonus is not just free money. It directly improves the mortgage deal you can access, which then saves you money every single month for years. The retirement use case is less talked about but equally powerful in the right circumstances. From age 60, you can withdraw everything in your Lifetime ISA completely tax-free. The contributions, the government bonus, and all the growth on top. No income tax, no national insurance, nothing. Compare that to a pension where you get tax relief going in but pay income tax on withdrawals. With a LISA, you get the bonus going in and pay nothing coming out. For basic rate taxpayers, the benefit is broadly similar, but the key distinction is this. A LISA is not a replacement for a pension. It is a complement to one. Your workplace pension, particularly if your employer matches contributions, should always come first. The LISA sits alongside it as a second tax advantage pot working in a different direction. Now the part that catches people out. If you withdraw money from a Lifetime ISA for any reason other than buying a first home or turning 60, you pay a 25% government penalty on the full withdrawal amount. Not just on the bonus, on everything. Here is why that stings more than it sounds. You put in £1,000. The government adds £250. You now have £1,250. If you withdraw that for an unauthorised reason, the penalty is 25% of £1,250, which is £312.50. You get back £937.50. You have lost £62.50 of your own money, not just the bonus. This is not a theoretical risk. It catches people who open a lifetime ISA thinking of it as a flexible savings account and then need the money for something else. It is not flexible. It is a commitment. Only open one if you are confident the money will be used for its intended purpose. If there is any genuine uncertainty about whether you might need the money early, a cash ISA or a standard savings account is the safer choice for that portion of your savings. A question that comes up constantly: should I use a lifetime ISA or a pension? The answer is almost always both, in the right order. If your employer offers pension matching, always maximise that first. Employer matching is effectively a 100% instant return on your contributions. Nothing beats it. Once you're maximising that, the lifetime ISA is an excellent next step, particularly if you're saving for a first home. The 25% government bonus is competitive with basic rate pension tax relief, and the tax-free withdrawal at 60 has its own advantages. Where people go wrong is treating the lifetime ISA as an either-or against their pension. Think of it as your pension's complement, not its competition. The two accounts serve different roles and perform best when used together, rather than in competition with each other. 3 groups of people for whom opening a lifetime ISA today is a clear decision. First, anyone under 40 who plans to buy their first home in the UK on a property under £450,000. Open one immediately. Even £100 a month earns £25 of government bonus on top. Every month you delay is a month of bonus you cannot reclaim. Second, anyone under 40 who has maximised their employer pension, matching, and wants an additional tax-efficient savings vehicle. The lifetime ISA gives you a second pot that complements, rather than duplicates, your pension. Third, anyone under 40 who wants the government to contribute to their savings while they decide exactly what for. The only thing you cannot do is open it after 39. 3 providers worth knowing. Moneybox is the most beginner-friendly. The app is clean, setup takes minutes, and you can start with as little as £1. AJ Bell offers more investment choice and a broader range of funds for those who want more control. Hargreaves Lansdown is the most established name in UK investing, with a solid lifetime ISA product and strong customer support. All 3 are FCA regulated. All 3 apply the government bonus automatically. The difference is interface, investment range, and fees, worth spending 15 minutes comparing before you commit. Real numbers: 25 years old, £4,000 a year into a lifetime ISA. Government adds £1,000 every year, invested in a global index fund averaging 7% annual returns. By age 60, that account could be worth over £500,000, tax-free. The government will have contributed £35,000 of that total. You contributed £140,000. Investment growth did the rest. That is the compounding effect of a government bonus working alongside your contributions over 35 years. The lifetime ISA is not complicated. It is just unknown. A 25% government bonus on up to £4,000 a year for buying your first home or building your retirement pot. The only hard rules are the age limit and the property price cap. If you are under 40 and you do not have one, the question is not whether you should open one. The question is why you have not already. The best time was when you turned 18. The second best time is today. Before we finish, 3 mistakes worth knowing about. The first is treating the lifetime ISA as a flexible savings account. It is not. It is a commitment account with a real penalty for early withdrawal. Only put money in that you're confident you will not need before a first home purchase or retirement. The second is forgetting the property price cap. The lifetime ISA bonus only applies to properties at £450,000 or below. If your target area is above that threshold, the account is still valuable for retirement, just not for the property goal. The third is waiting until you are close to 40. Every year you delay is a year of free bonus you cannot reclaim. Opening it early with minimal contributions costs almost nothing and preserves the window entirely. The worst outcome is missing the age limit and realising too late. Next week we're covering pensions, what your employer is actually contributing, how salary sacrifice works, and why most people are leaving free money on the table every single month without knowing it. Subscribe so you do not miss it. New videos every week.